There's an event that happens every April in the American financial system that most people never think about. Tax season, not the filing, not the refund, the payment. Every April, trillions of dollars are extracted from the American economy as households, businesses, and corporations settle their obligations with the Internal Revenue Service. The money flows in one direction, out of bank accounts, out of savings, out of money market funds, out of brokerage accounts, and into the United States Treasury. In a normal year, the system absorbs this drain without incident. Banks have adequate reserves. Consumers have adequate savings. The economy has sufficient liquidity to sustain the withdrawal and continue functioning. 2026 is not a normal year. The banking system is sitting on $306 billion in unrealized losses. 60 banks are on the FDIC's problem list. The reserve requirement has been zero since March 2020. Consumer savings have been depleted by 50% in a single year. Credit card debt has reached a record $1.28 trillion. And the largest supply disruption in the history of the global oil market has been compounding financial stress on every household and every institution in the country for 6 consecutive weeks. The April tax drain is landing on a financial system that is already fractured. And the evidence that banks are responding by restricting access to your money is not theoretical. It is documented, it is accelerating, and it is happening right now. Let me show you the evidence, because it is the kind of evidence that most people will not see until they try to access their own money and discover that the rules have changed. The first and most visible sign is the private credit fund gates. On March 6th, BlackRock, the largest asset manager in the world, blocked nearly half of all withdrawal requests from its $26 billion private credit fund. 9.3% of investors in the fund requested their money. BlackRock capped redemptions at 5%. $620 million of $1.2 billion requested was returned. The rest was held, not delayed, held. The investors who wanted their money were told they could not have it. In the same period, Blackstone injected $400 million from executives' personal funds into its private credit operations to shore up confidence. Blue Owl Capital issued IOUs instead of cash to investors requesting withdrawals. Morgan Stanley capped its private credit fund redemptions at 5%. And the Bank of America Fund Manager survey showed that concern about private credit defaults surged to a record 46% among institutional investors. These are not small, obscure funds. BlackRock manages over $10 trillion in total assets. Blackstone is the largest alternative asset manager in the world. Morgan Stanley is one of the 6 largest banks in the United States. When institutions of this size and prominence begin restricting investor access to cash, it is not a localized problem. It is a systemic signal that liquidity in the financial system is tightening to the point where the institutions themselves cannot meet withdrawal demands without selling assets at losses they are unwilling to realize. The second sign is the banking system's structural vulnerability. United States banks are collectively holding $306.1 billion in unrealized losses on their securities portfolios. These losses were created when banks purchased treasury bonds and mortgage-backed securities during the zero-rate era at prices that assumed rates would remain low. When the Federal Reserve raised rates aggressively, the market value of those securities declined. The banks have not sold them, so the losses are unrealized and do not appear on the income statement. But they are real. If any bank is forced to sell those securities to meet withdrawal demands, the losses crystallize instantly. This is exactly the mechanism that destroyed Silicon Valley Bank in March 2023. SVB was forced to sell securities at a loss to meet deposit withdrawals. The loss triggered a confidence crisis. More depositors withdrew. The bank collapsed within 48 hours. The FDIC was forced to step in and guarantee all deposits, including those above the $250,000 insurance limit. Today, the conditions that created SVB's failure have not been resolved. They have been amplified. The unrealized losses across the banking system are still over $300 billion. The FDIC's deposit insurance fund covers just 1.35% of insured deposits. 60 banks are on the FDIC's problem list, the most since the aftermath of the 2008 financial crisis, and the bank reserve requirement has been zero since March 2020, meaning banks are not required to hold any reserves against deposits. The entire system operates on the assumption that depositors will not all request their money at the same time. That assumption held when confidence was high. It is being tested now. The third sign is Metropolitan Capital Bank. On January 30th, 2026, the first bank failure of the year occurred. Metropolitan Capital Bank, with assets of approximately $261 million, was closed by regulators who determined it was in an unsafe condition, with capital levels too weak to continue operating. The FDIC transferred deposits to First Independence Bank in Detroit. The estimated loss to the deposit insurance fund was $19.7 million. The failure was small and orderly. It did not trigger panic. But analysts noted that When the failure coincided with a brutal sell-off in precious metals and cryptocurrency, the situation began to resemble a signal of tightening financial conditions affecting multiple sectors at once. Small bank failures are often the canary in the coal mine. They appear at the edges of the system before the stress migrates to the center. The fourth sign is the commercial real estate maturity wall. $930 billion in commercial real estate debt is maturing in 2026. Office vacancy rates exceed 20% nationally. The borrowers who took out these loans at lower interest rates cannot refinance at the current rate of 3.5 to 3.75% without accepting dramatically higher payments. Many of these loans will default. The losses will flow primarily through regional banks, which hold approximately 70% of all commercial real estate loans. When a regional bank absorbs losses on its CRE portfolio, its capital ratios decline. When capital ratios decline, regulators force the bank to restrict lending and, in extreme cases, restrict withdrawals to preserve the remaining capital base. This is not a theoretical scenario. It is the documented regulatory response to bank undercapitalization. When a bank's capital falls below the required minimums, the FDIC issues a prompt corrective action order that can include restrictions on deposit gathering, lending, and, in the most severe cases, the appointment of a receiver who takes control of the institution entirely. Now, let me show you how the April tax drain interacts with these existing vulnerabilities to create the conditions under which banks begin restricting access to your money. Every April, the United States Treasury collects approximately $3 trillion in individual and corporate income tax payments. That money comes from bank accounts. When a household writes a check to the IRS or makes an electronic payment, the funds are debited from their bank account and credited to the Treasury's account at the Federal Reserve. The bank loses the deposit. In a normal year, the outflow is temporary and manageable. Tax refunds flow back into the system. New deposits arrive. The seasonal pattern reverses within weeks. But in 2026, the tax drain is hitting a system where the deposits are already under stress. The personal savings rate has fallen to 4.4%. The median emergency savings balance dropped from $10,000 to $5,000 in a single year. 27% of Americans have zero emergency savings. 43% cannot cover a $1,000 emergency expense. 53% are living paycheck to paycheck. The households that are making tax payments in April are drawing down savings that have already been depleted by 4 years of inflation, 6 weeks of war-driven energy costs, and the compounding burden of $1.28 trillion in credit card debt at 22% interest. Many of these households will not replenish those deposits after the tax payment. The money is gone permanently, sent to the Treasury to pay an obligation that was incurred on last year's income that was earned before the oil shock, before the war, before the stagflationary environment that has reduced their purchasing power and their ability to save. For the banks, this means deposit balances decline. When deposits decline, the bank's funding base shrinks. When the funding base shrinks, the bank must either reduce its assets by selling securities at a loss or replace the deposits by offering higher interest rates to attract new money. Higher deposit rates compress the bank's net interest margin, the difference between what it earns on loans and what it pays on deposits. Compressed margins reduce profitability. Reduced profitability weakens capital ratios. And weakened capital ratios trigger the regulatory responses that restrict the bank's ability to operate normally, including in the most severe cases, restrictions on withdrawal access. This cycle is already visible in the data. Jamie Dimon of JP Morgan Chase compared the current market environment to 2005 through 2007 in his annual shareholder letter published April 6th. He warned that losses on all leverage lending will be higher than expected relative to the environment. He said actual losses are currently higher than they should be. He used the word cockroaches to describe problem loans. He warned that the national debt will probably become a crisis rather than being addressed proactively. And he said the skunk at the party would be inflation slowly going up as opposed to slowly going down. When the CEO of the largest bank in America uses language this explicit, the message to the financial system is unmistakable. The credit cycle is turning. The losses are coming, and the institutions that are positioned to survive will do so by protecting their own balance sheets, which means restricting access to capital for borrowers, investors, and in extreme cases, depositors. The Dodd-Frank Wall Street Reform Act, passed in 2010 in response to the 2008 crisis, fundamentally changed the legal framework for bank resolution. Before Dodd-Frank, failing banks were bailed out with taxpayer money. After Dodd-Frank, failing banks are bailed in, meaning the losses are absorbed by the bank's creditors, including, in some cases, uninsured depositors. A bail-in means that if your bank fails and your deposits exceed the FDIC insurance limit of $250,000, the amount above that limit can be converted to equity in the failing bank. Your cash becomes stock in a bankrupt institution. This is not speculation. This is the law. It has been on the books since 2010. It was invoked during the Cyprus banking crisis of 2013, when uninsured depositors at the Bank of Cyprus lost 47.5% of their deposits above the insurance threshold. It was the framework that applied during the Lebanese banking crisis of 2019, when depositors were effectively locked out of their accounts for years. The FDIC's own officials have acknowledged the fragility of the system. At an advisory committee meeting, members admitted that the industry professionals in the room had less confidence in the banking system than the American public did. The people inside the system know its vulnerabilities. The $250,000 insurance limit has not been raised since 2008, despite the inflation that has occurred since then. $250,000 in 2008 had the purchasing power of approximately $345,000 today. The real value of FDIC insurance has been eroding for 16 years, while the risks in the banking system have been growing. And the private credit dimension adds an entirely separate layer of withdrawal restriction that operates outside the FDIC framework entirely. Private credit funds are not banks. They are not insured by the FDIC. They are not regulated by the same frameworks. And they have no obligation to return investor capital on demand. When BlackRock caps redemptions at 5%, there's no regulatory authority that can force them to release the money. The investors agreed to the terms when they invested. The gate provisions were in the fine print. And when the gates are activated, the investors discover that the illiquid assets they were told would generate stable returns are actually illiquid in the truest sense of the word. They cannot be converted to cash when the investor needs it. The private credit market has grown from $300 billion in 2010 to $1.8 trillion in 2025. Default rates have passed their 2008 peak at 9.2%. $265 billion in private credit assets are gated or facing redemption pressure. Hedge funds have begun developing instruments to bet against segments of the private credit market, including synthetic short positions on private credit indices. Goldman Sachs and JP Morgan have reportedly created tools enabling these bearish positions. When the largest banks in the world are creating instruments for sophisticated investors to profit from private credit's decline, the trajectory is clear. So what do you actually do to protect yourself from a financial system that is increasingly restricting access to your money? First, ensure that no single bank account exceeds the FDIC insurance limit of $250,000. If you have more than that in any institution, spread it across multiple banks. Each separately chartered bank provides an additional $250,000 in coverage. Joint accounts double the coverage. Different ownership categories, individual, joint, trust, retirement, each receive separate coverage. Structuring your deposits to maximize FDIC coverage is not paranoia. It is the basic due diligence that the FDIC itself recommends. Second, hold Treasury bills directly rather than through bank deposits or money market funds. When you own a Treasury bill, you hold a direct obligation of the United States government. There is no intermediary, no bank, no fund, no counterparty that can gate your access. When the bill matures, the cash is returned to your Treasury direct account or your brokerage account. This is the structure that Warren Buffett uses for his $373 billion. It is not coincidental that the greatest investor in history holds Treasury bills directly rather than in bank deposits. He understands the counterparty risk that most retail investors do not. Third, maintain liquid cash outside the banking system. Physical cash, while not earning interest, cannot be frozen, gated, or restricted by any institution. A household emergency reserve of 1 to 3 months of expenses in physical cash provides a buffer against any short-term disruption to banking access. This is not a recommendation to withdraw all your money from banks. It is a recommendation to diversify your liquidity across multiple access points so that no single institution's decision can leave you unable to pay your bills. Fourth, avoid private credit funds, non-traded RATs, interval funds, and any investment vehicle that includes gate provisions in its redemption terms. The promise of higher yields comes with the risk that your capital will be locked when you need it most. The BlackRock gate, the Blackstone injection, the Blue Owl IOUs, these are not anomalies. They are the predictable consequence of investing in illiquid assets through structures that promise liquidity they cannot deliver during periods of stress. Fifth, monitor your bank's financial health. The FDIC publishes quarterly data on every insured institution, including capital ratios, asset quality, and profitability metrics. If your bank's capital ratios are declining, if its commercial real estate exposure is concentrated, if its unrealized losses are large relative to its capital base, consider moving deposits to a stronger institution before a problem materializes. The depositors who lost money at Silicon Valley Bank, at First Republic, at Signature Bank, all had access to the data that showed these institutions were vulnerable. They did not act on it until it was too late. Here's the truth that connects the April tax drain to the banking system's structural fragility. The $3 trillion flowing to the Treasury this month is not being extracted from a system with surplus liquidity. It is being extracted from a system that is already stressed by $306 billion in unrealized losses, 60 problem banks, $930 billion in maturing commercial real estate debt, $1.8 trillion in opaque private credit with 9.2% defaults, zero reserve requirements, a deposit insurance fund covering 1.35% of insured deposits, a war-driven oil shock that has sent energy prices above $100 per barrel, a consumer with depleted savings and record credit card debt, and a Federal Reserve that is frozen between cutting rates and fighting inflation. The banks will survive the April tax drain in aggregate. JP Morgan will be fine. The largest institutions have sufficient capital buffers to absorb the seasonal outflow. But the weaker institutions, the regional banks with concentrated CRE exposure, the community banks with thin capital ratios, the institutions that were already on the FDIC's 60-bank problem list before the tax drain began, these are the institutions where the combination of seasonal deposit outflows, war-driven economic stress, commercial real estate losses, and consumer credit deterioration creates the conditions under which withdrawal restrictions become necessary. And the private credit funds that have already demonstrated their willingness to gate withdrawals will continue to do so. The default rates are rising, the redemption requests are accelerating, the liquidity that was promised does not exist. And the investors who trusted the fine print are discovering that fine print is written by lawyers who work for the fund, not for the investor. The $3 trillion tax drain is not the cause of the banking system's fragility. It is the catalyst that tests it. It is the seasonal liquidity event that reveals which institutions are genuinely stable and which were relying on a favorable environment to mask underlying weakness. The environment is no longer favorable. The oil shock, the stagflationary data, the consumer exhaustion, the credit deterioration, and the war that has no clear end, all of these have transformed the April tax season from a routine seasonal adjustment into a stress test being administered to a system that the FDIC's own advisory committee members admitted they do not fully trust. Your money is your most valuable financial asset. Protecting it requires understanding that the institutions holding it are operating under constraints that they will not voluntarily disclose until the constraints become binding. The gates at BlackRock were not announced in advance. The capital injection at Blackstone was not predicted by analysts. The failure of Metropolitan Capital Bank was not on anyone's watch list until it happened. The system's fragility reveals itself at the moment of stress, not before. And April 2026, with $3 trillion in tax payments draining deposits from a banking system that is carrying more vulnerability than at any point since 2023, is a moment of stress. The question is not whether the system will be tested. It is already being tested. The question is whether your money is positioned to survive the test, or whether it is sitting in an institution, a fund, or a structure that may restrict your access precisely when you need it most. The evidence says the restrictions have already begun. The data says the stress is intensifying. And the calendar says $3 trillion in tax payments are landing this month on a system that the people inside it do not fully trust. Position accordingly. Because by the time the restrictions reach your account, the time to position has already passed. And let me walk you through the specific mechanics of how banks restrict access to your money in practice, because it does not look like the dramatic bank run scenes from the movies. It happens gradually, quietly, through policy changes that most depositors do not notice until they encounter them. The first mechanism is transaction limits. Banks can and do impose daily limits on ATM withdrawals, wire transfers, and electronic payments. Most Americans have never tested these limits because they never needed to withdraw large amounts of cash quickly. But when you try to wire $50,000 to another institution, you may discover that your bank requires 24 to 72 hours notice, identity verification procedures that were not previously required, and in some cases, a personal visit to a branch. These delays are presented as security measures. In reality, they slow the velocity of deposit outflows, giving the bank time to manage its liquidity position. The banks that are most likely to tighten these restrictions are the ones experiencing the most stress, the regional banks with concentrated commercial real estate exposure and thin capital buffers. The second mechanism is hold policies on deposits. When you deposit a large check or receive a wire transfer, the bank can place a hold on those funds for several business days before making them available. During the hold period, the money is in the bank's possession, but not in your accessible balance. This is standard banking practice under the Expedited Funds Availability Act, but the hold periods can be extended during periods of bank stress. A bank that is experiencing liquidity pressure has a financial incentive to hold deposits longer because those funds provide a temporary cushion to the bank's reserve position. The third mechanism is account closure. Banks have the right to close customer accounts for virtually any reason, including accounts that they determine pose excessive withdrawal risk. If a bank identifies a customer who is systematically moving large sums out of the institution, the bank can close the account and issue a cashier's check for the remaining balance. The customer receives their money, but the process takes days or weeks, during which the funds are inaccessible. This mechanism is rarely publicized, but it is documented in the terms and conditions that every depositor agreed to when they opened their account. The fourth mechanism is the one that most people never consider because it has not been widely used in the United States since the 1930s, a bank holiday. During the Great Depression, President Roosevelt declared a 4-day national bank holiday on March 6, 1933, closing every bank in the country to prevent the cascade of bank runs that was destroying the financial system. During those 4 days, no American could access their bank account, withdraw cash, or make a payment. The bank holiday was followed by the Emergency Banking Act, which gave the government the authority to determine which banks were solvent enough to reopen and which would be liquidated. The FDIC was created in the aftermath. A national bank holiday is an extreme scenario, but regional bank holidays, in which individual states or regulators restrict access to specific failing institutions, are part of the FDIC's resolution toolkit. When Silicon Valley Bank failed in March 2023, depositors were unable to access their funds for approximately 48 hours until the FDIC arranged for the assumption of deposits by another institution. During those 48 hours, payrolls could not be processed, vendor payments could not be made, and businesses that relied on SVB for operating cash were functionally frozen. The system worked as designed, the deposits were ultimately made whole, but the disruption was real, immediate, and devastating for the businesses affected. Now, let me connect the tax drain to the broader macro environment that makes April 2026 uniquely dangerous for the banking system. The war in Iran has created the largest energy supply disruption in modern history. Oil prices surged above $104 per barrel on April 13th after Trump ordered a naval blockade of the Strait of Hormuz following the collapse of peace talks in Islamabad. JP Morgan's commodity analysts warned that pre-closure oil barrels will be fully exhausted from the global supply chain around April 20th. That is the same week that federal tax payments peak. The confluence of $3 trillion in tax-related deposit withdrawals and the exhaustion of the global oil buffer creates a dual liquidity squeeze that hits the economy from two directions simultaneously. Consumers are sending money to the Treasury while simultaneously spending more on gasoline. Banks are losing deposits to tax payments while simultaneously facing pressure on their energy-sensitive loan portfolios. And the Federal Reserve, frozen at 3.5 to 3.75% because it cannot cut rates while inflation is accelerating above 3%, cannot provide the liquidity injection that would ease the stress. The Atlanta Federal Reserve's GDP Now tracker collapsed from over 3% to 1.6% for the first quarter. GDP in the fourth quarter of 2025 came in at just 0.7% annualized. Consumer sentiment fell to 53.3. Bank of America revised its inflation forecast upward by 80 basis points to 3.6%. Goldman Sachs raised its recession probability to 25%. And Jamie Dimon wrote in his shareholder letter that a bad confluence of events generally causes various degrees of recession, which is accompanied by high credit losses, volatile markets, lower asset prices, and higher unemployment rates. He explicitly mentioned stagflation as a possible outcome for 2026. When the CEO of the largest bank uses the word recession in his annual letter while comparing the current environment to the years that preceded the 2008 crisis, the banking system is communicating something that its public relations department would never say directly. The interconnection between the banking system, private credit, the tax drain, the oil shock, and consumer exhaustion creates a web of vulnerabilities where each thread puts tension on every other thread. The consumer who depletes their savings to pay taxes has less money in the bank. The bank that loses deposits has less liquidity to fund loans. The business that cannot get a loan reduces its operations. The workers who lose hours or jobs spend less. The reduced spending lowers GDP. The lower GDP increases the probability of the recession that Dimon warned about. And the recession, if it arrives, triggers the credit cycle that has not occurred since the Great Recession, the cycle that Dimon said will produce losses on all leveraged lending that are higher than expected. The Bank of America Fund Manager Survey documented the fastest sentiment reversal among institutional investors in 30 years. Growth optimism collapsed from 39% to just 7%. Inflation fear surged from 9% to 45%. Cash allocations jumped from a record low of 3.2% to 4.3% at pandemic speed. United States equity allocations flipped to a net 17% underweight. The institutions that manage trillions of dollars are not waiting for the tax season stress to resolve itself. They have already moved to defensive positioning. They have already raised cash. They have already reduced exposure to the sectors and the institutions that the tax drain, the oil shock, and the credit cycle will damage most severely. Warren Buffett's $373 billion in Treasury bills is the most visible expression of this defensive positioning. $314 billion of it is in Treasury bills held directly, Not in bank deposits, not in money market funds, not in any structure that involves an intermediary who could gate, freeze, or restrict access. Buffett holds the actual securities. They mature in weeks. The cash is returned. No bank can prevent him from accessing it. No fund can gate his redemptions. No FDIC insurance limit constrains him. He has positioned his capital in the one instrument that is immune to every vulnerability in the banking system, every liquidity restriction in private credit, and every counterparty risk in the financial system. That is not a coincidence. That is the positioning of a man who spent 60 years understanding exactly how the financial system fails and who has structured his $373 billion to survive every failure mode he can envision. The information is available to you. The FDIC publishes its problem bank list. The unrealized losses are documented in quarterly call reports. The private credit gates are public knowledge. The commercial real estate maturity data is published by industry trackers. The consumer savings data is surveyed quarterly. The tax payment calendar is fixed and predictable. Every piece of information needed to assess the risk to your deposits, your investments, and your access to your own money is publicly available. The institutions that manage the most money in the world have acted on this information. The question is whether you will act on it before the April tax drain finishes testing a system that was already stressed to its limits, or whether you will wait until the restrictions reach your account and discover that the time to diversify your liquidity, spread your deposits, hold treasury bills directly, and maintain cash outside the banking system has already passed. The gates have already been activated at BlackRock, at Blackstone, at Blue Owl, at Morgan Stanley. The first bank failure of 2026 has already occurred. The FDIC's problem list has already reached 60 institutions. The unrealized losses have already exceeded $300 billion. The consumer savings have already been cut in half. And $3 trillion in tax payments are draining from the system right now, this week, this month. While oil is above $100, while the Strait is blockaded, while inflation is accelerating, while the Fed is frozen, and while the CEO of the largest bank in America is telling his shareholders that this looks like 2005 through 2007. The evidence is not hiding. It is sitting in plain view, documented in regulatory filings, published in shareholder letters, confirmed by fund gating announcements, and measured in the $306 billion of unrealized losses that sit on bank balance sheets like an unexploded ordnance waiting for the detonation that forces them from unrealized to realized. The April tax drain may not be that detonator, but it is applying pressure to a system that has less capacity to absorb pressure than at any point in the past 3 years. And the people who understand this, who have diversified their deposits, who hold treasury bills directly, who maintain emergency cash, who have exited gated investment vehicles, are the people who will maintain full access to their money regardless of which institution encounters stress. The people who have not taken these steps are relying entirely on the assumption that every institution holding their money will continue operating normally through the most challenging financial environment since 2023. That assumption may prove correct, but if it does not, the time to have acted is now, not after the restrictions have been imposed. Because restriction announcements do not come with advance warning. They come at 10 p.m. on a Friday night, in a press release that says the fund has exercised its contractual right to limit redemptions in the interest of all shareholders. And by Monday morning, your money is on the other side of a gate that you did not know existed until it closed.